Gold just did something that should terrify every single person watching this video, not because it crashed, because of why it crashed. And if you do not understand the why, you are about to make the most expensive mistake of the next decade at exactly the wrong moment. Here is the paradox. The Strait of Hormuz closes on March 4th. Bombs fall across the Middle East. The Iranian supreme leader is killed. Oil spikes from $75 to over $100 a barrel in 3 weeks. The United States national debt blows past $39 trillion. Central banks are buying gold at nearly double their historical average. And gold, the so-called financial bunker, the thing you were told to run to when the world catches fire, goes down. Down 21% from its all-time high of $5,596 reached on January 29th. Down to $4,428 per ounce as of late March 2026. And here is what makes me want to put my glasses on the table and stare at the ceiling. Retail investors saw that price action, panicked, and sold. They did exactly what the financial media wrote the script for. They bought the spike at $5,400 per ounce. They watched it fall. They concluded the thesis was broken. And they handed their position over to institutions at the bottom of a forced liquidation that every major bank on earth had already told them was temporary. Stop the madness. This is not a gold story. This is not a war story. This is a story about the biggest monetary reset in 80 years. And if you do not understand the mechanics of what is happening right now, you are going to miss the most consequential financial repositioning of your lifetime. Let me tell you exactly what happened to retail money over the past several weeks. Because this is almost painfully predictable, and yet it repeats itself every single cycle without fail. March 2nd, 2026, Operation Epic Fury begins. U.S. and Israeli strikes hit Iran. Markets open. Gold spikes to $5,419. Silver touches $96.40. Oil jumps 13%. And immediately, every financial media outlet with a camera and a red graphic is screaming about crisis. Buy gold, buy silver, buy defense stocks. And retail investors, bless their hearts, they do exactly that. They buy gold at $5,400. They buy silver at $95. They feel smart. They feel prepared. They feel like they read the room. 2 weeks later, gold is at $5,085. Then it keeps falling. By late March, it sits at $4,428. Silver is down more than 46% from its January high of $113. And the same media outlets that told them to buy are now running articles asking why gold is not working as a safe haven. Tears don't make you money, and they certainly do not change the math. Here is what actually happened. The very same oil shock that was supposed to send gold to $6,500 simultaneously created the exact monetary conditions that suppress gold in the short term. Oil spikes. Inflation expectations rise immediately, not actual inflation, expectations. And expectations matter as much as reality to financial markets because traders price them in instantly. The Federal Reserve, which had been hinting at rate cuts, is now completely frozen. Fed funds futures were showing virtually zero probability of a cut before late 2026 at the earliest. Bond yields rise. The 10-year Treasury is sitting at 4.39%. Now institutional capital has to do arithmetic. Why hold an ounce of gold that pays you nothing when a risk-free U.S. government bond pays you 4.39% annually with zero credit risk, zero volatility, and zero storage costs? Some of that capital rotates out of gold and into bonds. The dollar strengthens from petrodollar safe haven demand. The dollar index rises above 100. A stronger dollar mechanically suppresses the dollar price of gold because gold is priced in dollars, and when the dollar is worth more, it takes fewer of them to buy an ounce. 3 headwinds, simultaneously, all caused by the same oil shock that retail investors thought was going to make them rich overnight. They watched the financial media. They panicked. They bought at the top and sold at the bottom. Same movie, different year. Now here is the secret mechanism, the invisible gear that Wall Street understands and almost nobody explains clearly to regular investors. There are 2 prices for gold operating simultaneously in this market. There is the short-term price, which is set by the dollar, by bond yields, by speculative positioning, and by the mechanical relationship between oil and currency that every trading desk on earth exploits for profit. And then there is the structural price, which is set by the debt cycle, by the credibility of the entire monetary system, and by the accumulated weight of central bank purchasing decisions made over years and decades. Right now, those two prices are separated by the widest gap in 40 years. And the gap is not closing in the direction retail investors think. Let me give you the structural picture, because this is where the math becomes impossible to argue with. The United States is rolling over $9.2 trillion in federal debt this fiscal year at rates between 4 and 5%. Annual interest payments have already crossed $1 trillion, more than the entire defense budget. $1 trillion a year just to service the debt. It is just math, folks. You cannot raise interest rates to 20% like Paul Volcker did in the early 1980s to crush inflation, because today the arithmetic of servicing $39 trillion at those rates would produce a fiscal crisis that makes inflation look like a rounding error by comparison. The Federal Reserve is trapped. That means eventually, and this is the part that the short-term sellers are missing entirely, the Fed will be forced to cut. When it cuts, bond yields fall. When bond yields fall back below 3.5%, the opportunity cost argument against holding gold collapses. Institutional capital rotates back. The dollar weakens. And all three headwinds that are currently suppressing gold reverse simultaneously as tailwinds. 1 + 1 = 2. Now layer on top of that the forced seller problem. Turkey's central bank sold and swapped approximately 60 tons of gold worth more than $8 billion in just 2 weeks after the Iran war began. Turkey imports approximately 90% of its oil and 98% of its natural gas. When Brent crude went from $75 to over $100 per barrel, Turkey's annual energy import bill increased by approximately $20 billion. Not gradually, immediately. Because energy contracts are priced in dollars, and Turkey needs dollars, not lira, to pay them. The Turkish lira hit a fresh record low against the dollar at least 11 times since February 28th, 11 times in 16 trading days. And when your currency is in free fall and your inflation is already running at 37%, you sell whatever you have to defend it. You sell gold. Russia began selling gold in 2025 to finance war expenditures, raising approximately $2.4 billion through February 2026 and reducing its holdings to a 4-year low. Poland's central bank, which had been one of the most aggressive gold buyers on earth over the previous 3 years, proposed monetizing approximately 550 tons of its reserves for defense spending, $13 billion. China's People's Bank paused purchases in the fourth quarter of 2025. India became a net seller in January 2026 as the rupee came under pressure. Now listen to me carefully. That list represents the most powerful buyers of the entire gold bull market from $1,800 to $5,596, all becoming sellers simultaneously. And retail investors looked at that list and concluded the bull market was over. That analysis is dead to me. Because every single one of those central banks sold because a crisis destroyed their dollar inflows and they needed cash to survive, not because they changed their strategic view on gold as a reserve asset. Turkey sold because oil hit $100 and they needed dollars to defend a collapsing currency. Russia sold to fund a war. Poland needs to fund a defense buildup. That is not a change in thesis. That is a margin call at the sovereign level. And margin calls have ceilings. Countries cannot sell more gold than they own. Let me put this in historical context because I have lived through this exact sequence before. Not once, 4 times, 1976, 1983, 2008, 2013. Every single time forced selling hit the market, prices fell. Retail investors saw the fall, concluded the thesis was broken and sold. And every single time, when the forced selling exhausted itself, when the crisis that triggered it stabilized, the structural buyers returned and the price went to new all-time highs. Go back to October 1973. OPEC cuts production, slaps an embargo on the United States. Oil goes from $3 to $12 a barrel, a 4-fold increase. Gold initially drops. Then gold rises 150% over the following 2 years. And when you zoom out to the full arc of the 1971 to 1980 period, gold rose 2,300%. Not a typo. 2,300%. The investors who bought in 1973 and held through every pullback, through every period when the financial press declared the crisis over and gold had failed to perform, Those investors captured the full move. The investors who bought the spike and sold at the pullback missed the 2,300%. They were right about the direction, they were wrong about the time frame. The same mistake is being made today. The post-September 11th world, markets crash, panic everywhere. Then gold begins a decade-long bull run from $250 per ounce all the way to $1,900. That is a 660% move over 10 years. The investors who understood the structural setup and held through the volatility captured it. The ones who sold at the pullback watched it happen from the sidelines. I am a disciplined investor. I have been through all of it. I know exactly how this movie ends. Now here is the unthinkable structural setup. And I need you to pay attention because what comes next is not opinion. It is arithmetic. The arithmetic does not permit any other conclusion. Fact number one, the United States national debt is $39 trillion. In 1973, when gold began its historic bull run after the first oil shock, the national debt was approximately $500 billion. Today, it is 78 times larger. That is not a bigger version of the same problem. That is a categorically different fiscal reality. That fiscal reality creates a categorically different structural demand for gold over the long term. When governments face debts they cannot credibly repay at current interest rates, they eventually debase the currency. Every time in history. Let's be pragmatic. 1 + 1 = 2. Fact number two. Central banks are forecast to purchase approximately 850 tons of gold in 2026. Still historically elevated, far above the pre-2022 average of 400 to 500 tons annually. And here's what makes that number significant in a way most people entirely miss. When the United States and its allies froze Russia's currency reserves in 2022 with a keystroke, every single central bank in the developing world took note. If your reserves can be frozen with a keystroke, they are not really yours. Gold cannot be frozen. It cannot be printed, devalued, or sanctioned. That realization did not change because Turkey was forced to sell 60 tons to defend its currency. Turkey still knows that gold cannot be frozen. Turkey sold gold because it needed dollars in an emergency, not because it decided gold was no longer a strategic reserve asset. When the emergency passes, Turkey will buy gold again. Russia will buy gold again. Poland will buy gold again. The dollar share of global reserves has already dropped from 71% to under 58%, and the dollarization trend driving that shift is structural, not cyclical. Fact number three. Russia is banning gold exports from April 2026, making it illegal to export gold bars above 100 grams. Every Russian gold holder who wants the ability to move assets freely has a window of days to sell into the international market before that window closes permanently. That selling is adding to near-term pressure. But when it exhausts itself, a significant source of current selling pressure is removed permanently, and a significant producer is simultaneously locked out of the international market, tightening future supply. Now stack those three facts together. JP Morgan has raised its gold price target to $6,300 per ounce by end of 2026. Wells Fargo has lifted its year-end target to $6,100 to $6,300. UBS raised its target to $6,200 by September 2026. Deutsche Bank is standing by a $6,000 year-end target. These are not retail investor wishes. These are the research departments of the institutions that manage more capital than any other entities on Earth. They are watching forced liquidation and saying the structural case has not changed. They are watching it create the buying opportunity that comes before the biggest reset yet. Here is my framework. 3 phases. Learn them. Because knowing which phase you are in changes everything about what you should do with the information I have just given you. Phase 1 is the forced liquidation phase. This is what we have been living through. The sellers are not making strategic decisions. They are meeting obligations. Turkey is defending a currency. Russia is funding a war. Poland is considering defense spending. The selling pressure is real. It is large. And it is by definition finite. Countries cannot sell more gold than they own. This phase is characterized by emotional retail investors either panic selling at the bottom of the initial drop or panic buying at the absolute top of the initial spike. Both are typically wrong, and institutions are doing what? Watching. Positioning quietly. They have seen this movie before. Phase 2 is the stabilization phase. This begins when the original crisis driver starts to moderate. Watch the Turkish lira and watch Brent crude. The lira has hit a fresh record low at least 11 times since February 28th. When it stops making new lows, one of the two largest confirmed sources of forced selling will have turned. When Brent crude falls back toward $85 to $90 a barrel, the marginal dollar demand forcing Turkey's hand diminishes. The lira stabilizes, forced selling slows. Gold recalibrates toward its structural price rather than its crisis liquidation price. This is the phase where the largest number of individual investors make their most expensive decision. They look at the portfolio, they see red, they read a headline about gold failing as a safe haven, and they sell. In 4 decades of watching markets, I have seen this after every major crisis, and in every case, it was the worst possible time to sell. Phase 3 is the structural re-entry. This is the phase that retail investors almost always miss, because by the time it arrives, most of them have already sold in Phase 2, told themselves the thesis was wrong, and moved on. The structural buyers return. China and India have not signaled any reduction in their accumulation programs. The People's Bank of China ran 15 consecutive months of gold purchases through January 2026. The strategic buyers have not left. They have paused or been temporarily forced to sell. When they return to a market where the forced selling has already occurred and the price has already reset. They return at scale. And the move in Phase 3 is not the 2-week spike of Phase 1. It is the structural multi-year move, the one that turned $10,000 into $243,000 over 9 years, as the 1973 investors who held through the volatility discovered. Be pragmatic. Know which phase you are in. Do not let the noise of Phase 1 or the pain of Phase 2 make you miss Phase 3. Here is exactly what you do. 2 metrics, that is all you need to watch. Everything else is noise. Watch the dollar index, currently elevated above 99 due to petrodollar demand from the oil shock. When it falls back below approximately 97, the primary mechanical headwind on gold prices diminishes. This happens when oil stabilizes and alternative supply routes absorb enough of the Hormuz disruption to reduce the emergency dollar demand the shock created. Watch the 10-year Treasury yield, currently sitting at 4.39%. When it falls back below 3.5%, the opportunity cost argument against holding gold collapses. Institutional rotation out of treasuries and back into gold becomes mechanically favorable. This happens when the Federal Reserve begins cutting rates, which will happen when the debt arithmetic of $39 trillion at 4 to 5% makes it impossible to continue without producing a fiscal crisis more severe than the inflation it was trying to prevent. Now, let me tell you what to ignore. Ignore the daily oil headlines. Ignore the CNBC segment about gold failing as a safe haven. Ignore the 24-hour financial media cycle designed to maximize your anxiety so you make emotional decisions on their timeline. None of that changes the structural math. The debt is real. The debasement is coming. The institutional buyers are patient. The forced sellers have finite gold to sell. The reset that Scott Bessent, the actual United States Treasury Secretary, is openly describing as a Bretton Woods realignment is not a conspiracy theory. It is stated policy. And the last time the world went through a monetary reset after the Second World War, it completely changed the rules of money overnight. The people who understood the new rules built generational wealth. The people who held cash were slowly and quietly crushed by the inflation that followed. I am a disciplined investor. I do not trade on emotion. I do not panic sell at the bottom because a network showed me red graphics and dramatic music. I look at the debt. I look at the yield. I look at where the structural money is actually flowing. And right now, every single one of those indicators is pointing in exactly the same direction. Watch the yield, watch the dollar. Be patient, be disciplined, or the market will eat you alive.